Hey traders, welcome to Charts and Coffee. Happy New Year. We're taking a look at the first trading day of this new year, which frankly, we have a funny couple of days between now and next Friday. So normally the first Friday of every month is non-farm payroll. Big jobs data, very meaningful to the macro trend, that rate of change of employment, coupled with that rate of change of inflation. That's where the bulk of the FOMC monetary policy messaging and the actual policy shifts are made. Now, we know that January looks like a hold. So today's the 2nd of January, and on the 29th, 27 days from now, we're going to have that next decision on rates. And right now, it's not looking very likely for a cut. And there's been a little bit of a tantrum since then. You can see that the trend has definitely been wobbly since this giant down candle, and that was Powell Wednesday. We really haven't recovered from that. And that's because I'm sure there's many reasons, but the primary reason that I'm going to cite for this uneasiness is the fact that we don't have a clear path to how many more rate cuts are left. Right now, the data shows one or two at most, and when those will come and when those will be completed, right? So if we go out to a year from now, we look at, say, the December Fed Fund futures, we can see we're anywhere from 1/4 point to 1/2 point lower than we are right now. Granted, lots of things can change. We have a lot of things that are happening in January alone. New administration being the most significant in terms of what it is the market, traders, investors have to process, and then what is Jerome going to do? What is that jobs number saying, and whether or not that will have any impact on whether or not we get a cut in January. I'm going to presume we don't get a cut because that's what the data says right now. So until shown otherwise, I'm going to trade knowing there's likely going to be chop where I'm still bullish for the most part. But right now, it'll probably make a lot of sense to be really cautious between now and the end of the week. We do have two events coming up tomorrow. One is you can see here, the ISM manufacturing PMI. It's a pretty impactful piece of data. Is it a PCE? Is it a CPI type level data? No. And then we have FOMC Barkin speaking at 11. Is that a major speaker? Barkin's created some definitely some, well, one, her messaging has not necessarily been in lockstep with the FOMC's, with Powell's. And we might have some volatility at 11 o'clock. So these are things that we know tomorrow might be somewhat impactful. Today, look, we're still dealing with the Asian Session Bank holiday. We do have crude oil inventories at 11 a.m. And you can see here at 9:45, we have some final manufacturing PMI. The weekly unemployment claims have come out pretty flat, slightly less than expected, but it's 11,000 less than expected when there was 222,000 and got 211. Now, you might say, Rog, is 11,000 much better than expected? It's better than expected, right? It's better than what was forecasted. And we're still in an environment, anytime we're waiting on the kind of clarity that we need for the Federal Reserve to cut or hike or make any kind of shift. In this case, the shift from one cut to the next, disappointing data, meaning weaker jobs data, is what would compel them to continue on with more accommodative monetary policy. This is not that. Hence, I would expect a little bit of weakness in the wake of that 830 number. Okay, so we're kind of back in a good data is bearish and bad data is bullish environment. And this is not a lot of clarity to kick off the year. So if there's any gear that, and I got to turn that alert off. If there's any gear that you want to shift into right now, neutral is fine, right? Neutral is fine. And ultimately what we want to remember is if neutral is a fine gear to be in, flat is also a position. There's no harm saying, you know what, we were pretty active. I'll tell you what we did in the mastery. Very active through October, very active through November, pretty active through to December. And I would imagine that I'm not going to see a whole heck of a lot that I love in terms of getting busy. The pool of uptrends continues to recede. So there's less to like. And that's a really important thing to keep in mind when we're looking for trades. If there's less to like, organically, our watch list should be fewer, and organically, we should have fewer trades. We don't always power along at the same speed. Obviously, if I'm looking at the way in which a longer watch list of more uptrends keeps me busy, a shorter watch list of fewer uptrends will keep me less busy. And these are normal and frankly strategic things to do. And this notion that every month is going to present the same number of opportunities. When traders say, how many trades do you take on average? There's no such thing. Right? These are questions that make perfect sense until you start thinking about the market from the perspective of taking what it gives you, as opposed to saying, well, this is what I do, and this is what each month is going to present. Nobody knows that. Again, that's really teetering into prediction. All right. That said, it probably won't hurt to have a little bit more of a short-term approach. Now, let me be totally frank. Disappointingly, day trading's been relatively awful. The follow-through has not been of the sort where we get those great trending days and some sort of inflection point in the morning leads to a massive bounce or a big sell-off. The follow-through has been difficult. It's not as if there haven't been triggers. Just the follow-through has not been as sustained. It hasn't been as crisp. The volatility has been higher. All these things. And by the way, let me mention volatility being higher intraday. Volatility is not just movement. People don't want volatility, gang. I know everyone says, oh, the market's not volatile enough. What they really mean, and lack the vocabulary clearly for, is we like trends, right? We like trends. So let's use the right word. It's not that volatility is high or low. Frankly, high volatility doesn't serve most people unless you're writing option premium, okay? In which case, if you have good timing, and that's a big if, and you can capitalize on that higher volatility, there's money to be made, especially in a non-trending environment. However, we like trends. So volatility is, for me, that thing that I've got to deal with when I've got a support zone or a resistance zone, and I expect there to be good adherence to it. It's respected. It holds, right? Volatility is we're going to hold in that area, but not without some wicks that are going to pierce it, that are going to show that while that support zone is there, it's not as firm. It's soft rather than a solid zone where it can hold price, contain it. Price might escape, but then pull back. That's volatility, at least to me. That's no fun. We love trends. We actually don't love volatility. All right. Okay. By the way, Jerome Powell on the daily time frame on the 18th, that's volatility. The intraday downtrend, right? That was a trend. So here's another point. The time frame you look at is going to have a lot of bearing on the way that we experience whatever's happening. Someone could say, oh my God, what a huge down day on a 5-minute chart. On the daily, it might be pretty negligible. So remember, the time frame is that slice of psychology. Make sure that you're not thinking that slice of psychology is the only slice of psychology. All right, that being said, let's take a look at these sectors here. This is the 1-month look back on the normalized performance, and nothing's really changed all that much. Probably the most notable thing in December, markedly different from October and November, is that the number of uptrends that we had were severely cut in December, most especially after Powell. We're dealing with less clarity to the upside, which is something we haven't dealt with in at least a quarter or so. Right? The lack of clarity to the upside, the lack of broader participation in the sectors, and the lack of broader participation of the stocks in those sectors. We haven't dealt with such a short uptrending list. And all of these things I say, not to, kick off New Year with a disappointing note, but to kick it off with a realistic note. Continue to enjoy your New Year festivities. This is not the time to say, hey, it's a new year, it's back to work. That's an employee time-based mindset. We are in a results-based, more entrepreneurial mindset. Is there an edge? Is there an opportunity? If you wake up in the morning and say, not so much, continue to monitor. This is a not so much phase, right? I'm looking at right now, 1 month look back. Jets, XLY, and semiconductors. That is all that was positive. That's it. Everything else is at zero or less, right? A negative return. That's hugely different from when about 2/3 of that list was positive to some degree, and about the bottom 1/3 was negative. This is a very different environment. And if we don't make those kind of assessments, week to week, we're going to be chasing things that were, not chasing things that are. We trade the right side of the chart, and we don't trade what happened a quarter ago. We don't trade our favorite stock because that's what we like to wake up. What's a great example of favorite stock? Great example of favorite stock or favorite index is I'm an S&P trader. Unless you're making a market in a particular symbol, and I got to imagine most of us here are not doing that, to say this is what I trade, this is the only market I trade, is absolutely obtuse, right? Why would we take this giant playground of many symbols, some of which are trending, some of which aren't, and say, well, this is all I trade? Why? What advantage does that give anybody? Specialists and market makers have a very different job than a trader, right? So be careful thinking, well, specialists do that. They get paid in a very different way. They get a different set of information, right? It's a very different game they're playing. So ultimately, what we want to do is find where the trends are, far fewer. You might say, Rob, what about downtrends? Well, as long as we're dealing with a Federal Reserve that is not necessarily hiking rates, are just not as committed to the cuts as they once were, I don't know that I'm overwhelmingly bearish, but there might be some bearish opportunities. However, let's also juxtapose Q4 to Q1. Q4 is strength typically gets stronger. We saw most of that in November. Most of the performance chase happened shortly after the election. That 4-year election cycle did change the timing of a lot of what we typically see in December and shifted it to post-election November. All right, so that aside, the typical pattern of strength gets stronger, weakness gets weaker. So think performance chase, window dressing, and tax loss harvesting. Like tax loss harvesting is the weakness gets weaker and strength gets stronger is the performance chase, the window dressing, the Santa rally, what have you. And then the other thing it is Q1, that it makes Q1 different is this. Q1 is a blank page. Q1 is a fresh sheet. Q1 is 12 months ahead before we have to report, right, to ourselves, or if you're a money manager, the results for the year. So am I going to buy things that are already at highs, or am I going to go bargain hunting, take profit in things that worked really well through, say, the second half of the year, Q4, right? December wasn't bullish, but Q4 was bullish, right? So are they going to take profits in those symbols and then go to work bargain hunting and things that underperform? That's the very common Q1 sector rotation. There's usually one step that comes before that. Again, this is not widespread. We can't say that everyone's going to do this, but one of the other things is that late in December, we see a little bit of a move to bonds. I don't in any way think that was a meaningful move this year. What that would create was a little bit of support, which it did the latter half of the year. Not a lot of strength, though. So if there was that rotation out of stocks and into bonds, it was mild at best. At best. Again, we could never account for how many folks make that adjustment, but it's a common one at the end of the year. So it's on an uncommon one at the end of the quarter, but most definitely it's a more common one at the end of the year. So if we see that, that's oftentimes a precursor to sector rotation. Take profit into year end, move into bonds and into the Q1, see what kind of bargain hunting we can take advantage of. And that's where this graph is so important, because I'm not going to bargain hunt necessarily in technology or semiconductors. The bargain hunting is usually going to be done in the lower part of the normalized performance. So would metals and mining, or home builders, or basic materials, regional banks, solar, energy, gold, could those be candidates for sector rotation? We can narrow the field down. Yes. Can we pinpoint exactly which sector, which stock? No. All we can do is say that, you know what, it's a great big lake that I want to fish, but I know the fish are probably biting around this shoreline or at this depth, right? Those are things that we can do to increase the probability that we're looking in the right place. But after that, that's after we kind of minimize the list, then we're going to go take a look at those ETFs and start to see if A, we get weakness in some of those, very few, but stronger stocks and sectors, and B, if we start to see around the same time strength in some of those sectors or stocks within those sectors, moving higher. I don't mean just flying higher, but stabilizing and maybe catching a bid, right? Meaning buyers are willing to start coming in. So those are the things that I would look for. And that's the push pull of sector rotation, which is really just fancy verbiage for profit taking to bargain hunting. That's really all that it is. Sector rotation sounds so fancy, right? No, it's just profit taking to bargain hunting. And again, we know where the profits can be taken, strong sectors. We know where the bargain hunting can be. So any of these names that are negative, especially in the lower half, and look what's in the lower half. You've got everything from industrials to insurance, oil and gas explorers, real estate, oil services, gold miners, energy, solar, regional banks, basic materials, home builders, and then the very, very bottom, you've got metals and mining. And that's where we are as we kick off the year. And if this kind of approach is something new, come definitely check out what we're doing in the mastery, because this is the sector not so secret. Can we take a look at where the flow is? Can we take a look at where the optimism and the strength is, and continue to focus on those stocks and sectors to the upside? There are a few stocks and sectors that look pretty darn good, but as December rolled on, things got, this consumer discretionary was one of the strongest sectors throughout 2024. And then as we're wrapping up 2024, got the first red candle in consumer discretionary in a very long time. Amazon's holding pretty well. If you're looking for something that's holding pretty well, keep an eye on Amazon. Tesla, another stock that's holding quite well. Again, not all the magnificents are magnificent. Apple, holding quite well. Microsoft, that's a no, right? Meta, that's a maybe. Not as good as Apple and not as good as the other green stocks like Amazon and Tesla. What about Google? It's been doing pretty well since that Willow announcement. I'd put Google on that list. So if you're looking at some of the names that we would consider to be magnificents, and I would say I would take NVIDIA off the magnificent list and maybe put in AVGO in its place. AVGO, Apple, Google, Amazon, Tesla, they're pretty magnificent right now. The individual sectors, not so much, because so many of the stocks within them are underperforming. So we're going to have to be stock pickers for a little while, right? Is it always a stock pickers environment? I mean, really it is. Sometimes there's a whole lot more to pick from when lots more stocks are rising with the tide, and sometimes there's a whole lot less to choose from, which is where we are right now. And it's probably a little bit more an environment for discerning stock pickers. Stock pickers, you can say, look, I know folks are talking about this one symbol. I know folks are liking this is their favorite thing to do. It's a favorite stock. I like to call it fanboy, fangirl, meme behavior type stock, right? There's a lot of those. If you want to focus on where some of that attention is, like PLTR, go for it, right? Go for it. Keep an eye on the volume, but go for it. There's been some interesting setups with the attention placed on stocks in the FFTY. That may not be a bad place to look for potential stocks that are getting a lot of attention. This is basically the IBD 50 list, right? This is an ETF that reflects some of the top weighted stocks in the IBD 50. If there are trends there, probably pretty much guaranteed attention as long as they're on that list. PLTR has been a big beneficiary of that, as has RKLB. So keep an eye on those. Pretty affordable names. Some of the very rare quality of being a trend right now as we're kicking off 2025. Here's where I'd look. Here's why. All right. Here's why and where. And I'll see you tomorrow. Same time, same station, gang. Again, Happy New Year. Looking forward to trading with y'all for yet another year. And I'll see you all tomorrow. Same time, same station.